And thank you very much for joining and welcome. We've got Tony here. So Tony's founder of TrustMe Property Exchange. So Tony is from a background, a family of 200 years of banking. He's founded 28 tech companies. He's also ex-military and an ex-Olympic cross-country skiing coach, but he's now been working in the crypto and property space for a while. So is due to be talking about his TrustMe exchange. So everyone, thank you very much for joining. This is a cryptocurrency live chat where we're just speaking to the founders of some of the new companies and some of the tech companies around to see what everybody else is up to. So Tony, over to you. Tony, thank you very much for joining us.
No, Erica, thank you very much. Listen, everybody, welcome to a webinar on TPX. That's the TrustMe Property Exchanges. We have some new information flowing out here for many of you. Some of you know us, some of you don't. But either way, I hope to make this more middle of the road type presentation and to make it a little more topical, a little more interesting, and hopefully a little more fun than your standard Zoom session. Hopefully many of you are cheering in the background, even though I can't hear you. So without further ado, I'm going to introduce the TPX exchange and what we're doing and talk a little bit about the industry and the markets and where the post-pandemic economy, we think, from the TPX point of view, is going to. I have to chuck a couple of caveats in here. A lot of the things I'll be speaking today, in no way, shape, or form, you know the drill, represents market advice. We're not making any particular views on any organizations mentioned here. We're just trying to give you the facts and where the market sits, and everything that we produce is evidence-based. So without further ado, let's hear about the TPX. Now, the TPX is doing different things in different markets, and our approach is to launch regulated property exchanges around the world. To be very clear, our target is to launch 20 exchanges over the next 18 months. The first exchange due to be in London very, very shortly. There's some evidence as to when that will be, but we're working with a number of partner companies here to launch the exchanges on a new model for making property a liquid tradable asset class for all. And is physically based on the property itself. So this is not a REIT for those who are in the marketplace. This is fundamentally investing in the title of property itself. If we get this right, it'll be a major shift to the property trades in the future. What do we do for all ends of the spectrum? Our focus is to bring liquidity to the asset class. But we do address a few key problems. When we designed the technology and the thinking and the vision some 4 years ago, in the journey that we had already identified that there were problems in the marketplace. This is pre-pandemic. This is pre a lot of the economy that we're now dealing with. And we identified that there was a problem in the system. Property was becoming ever more expensive. And for the younger generation, or the millennial, Generation X, Generation Z, the aspiration of owning a property was starting to fade, to the point that you started to see this. The millennial problem. For those who are out there, you can see on the bottom line, this is a real game. You can buy it on Amazon. It's monopoly for millennials. And the key tagline is, forget real estate, you can't afford it anyway. TPX Property Exchange, you can see there that our aspirations are for London. The TPX Property Exchanges formed in 2016 and have been working diligently to get this particular exchange out. The millennial game here that you can see is very much where we're addressing some of the problem. There is an ESG agenda, impact agenda to what we're running with here. Fundamentally, as I've already stated, is to make property a liquid tradable asset class. And you can see there, part of the problem we're addressing is the aspirations of the millennial generation, Generation Z, X, as you may call it, where the aspiration of owning a property is a faraway goal. And increasingly, you know, we're discovering that 30 or 40 or even 50-year-olds these days find the aspiration of owning their own home is something that they couldn't address in their lifetimes or don't feel that they can. Part of the aspiration of the exchanges and what we're trying to do is to close that gap. But it's actually becoming more acute. And I'm going to show you another quick excerpt here from the recent news. It is controversial to a degree, but it does sum up the problem very, very well. So without further ado, please have a listen to this.
How can you win? How can you win? You can't win.
And you can see the problem. We don't look after our younger generation at our peril. The financial system is moving in a different direction. This is a macroeconomic, and this is opinion. The financial system is increasingly divorced from the reality of people's lives, we would argue. And increasingly, the instruments that are traded on it are becoming alien, difficult to understand, requiring professionals to be able to trade with them and for them. In the 50s, you used to see over a very high percentage of people retail element with equities on exchanges, buyer, broker, or other aspects as a means of savings, as a means of generating wealth. Increasingly, those numbers have, and our exposure as a population is down to 20 or 30%, where fewer and fewer people feel that they have the requisite skills to, or knowledge, or confidence even, to trade on these exchanges. There are answers here. There are answers that are coming in. There are problems, the monetary policy, the fiscal policy, the helicopter money, don't get me on that subject, that we're all seeing today. And that has its perils. We're currently spending money from the future for our todays, which is fine. We're in a pandemic, we need the support. And many people are furloughed, looking to get back to work and reestablish the economy. But there is inequity in the system. And we think that through this shift of what's happening, we're going to see a shift back to what we call an asset-backed economy. And we're preparing the exchanges and have been preparing the exchanges for the last 3 years ostensibly to meet that need. It's not just here, you can see it also in the debt bubbles. If you look at some of these diagrams here, you can see the cryptos, you can see a very small percentage, very small people actually have exposure to cryptos. Going down, you can see the gold, stock markets here. You can see the money, the amount of money in circulation, roughly $95 trillion. Real estate, depending on whose numbers you're looking at, Savills et al., 217 here, 226 by Savills numbers, 260 by some recent evidence, recent reports. So 260 trillion. Then we get on to the more difficult problem, the global debt. Increasingly, debt arguably is unsustainable in most of our economies. And this is part of the problem. And indeed, most of the system is generated, is designed in many ways to create money, to lend money, which creates more debt. Those debts eventually need to be paid off in some form or another. And if you look at the graph down here at the bottom, you look at the derivative markets, derivatives, fractional reserve lending, which we see in the banks, real assets, the very point of that bottom triangle. That's the real economy. And it's disturbing when you see it in that context. In the crypto world, then, we've got a lot of cryptos trading, highly volatile, trader's paradise, I might imagine, a good place for traders to make good money, powered by many people and the aspirations that many people have to make money. Currently, I think the last check, I checked yesterday, 5,585 different cryptos out there in one form or another, some good, some bad, some probably shouldn't be listed at all. And the top 10 continue to power on in one form. They have tremendous efficiency. We are part of that world. We believe in the blockchain technologies and what they can do. We believe in the evolution of the crypto world and what that can do for people and for everybody, hopefully on this call, in due course. And the efficiencies that it can gain are already starting to be seen in the market as we see more and more institutions starting to embrace the core distributed ledger technology or blockchain technologies in their economic systems, supply systems. It's all about trust, as many of you will, I'm sure, be aware. And that's part of our world too. So when we built our exchanges, we had focused on taking what is basically third-party distributed trust and engaging our communities to make sure that that's part of our DNA in everything that we do. In the exchanges, we make sure that, for example, all of the properties, which I'll come on to the exchanges in a moment, all of the properties that we have are properly registered on the blockchain. So beyond this, we have the eToros, the Robinhoods, fractional shares, contracts for differences. There are some interesting points there. I'm not here to comment particularly on them, but I do make the observation that on the front sites of all of these exchanges that you see in platforms, they have to list out that said the amount of retail investors that actually make money on their platforms. And what you'll see is here, 75% of retail investors lose money when trading on these platforms, 76.8, 73.5, there's some in the 80s. And so what type of retail experience would those customers have if they are losing money every time they trade? This is not a healthy provision for the marketplace on the long run. And a lot of platforms continue to grow and have very aggressive marketing campaigns to allow people to continue to invest through them. But they are shifting the market. And this is the observation here. And this is relevant for everybody here who are interested in this world, not only in the crypto sense, blockchain technologies, also in the property side, because some of this is coming home to roost in your local property markets. Right now, we've got fractional ownership of equities, and it's starting to shift the market. We have over 100 million here. There's a fantastic story that's circulating at the moment from the US where Hertz, the car rental agency, shares went up 890% almost overnight. There was no good reason for it other than it was a well-known brand name. And it's not absolutely certain even now why it went up so quickly, because they're having trouble. But the millennial generation, Generation Z, X, through the Robinhood app, shifted the marketplace. And so that's a tokenized version of an equity. It's a digital representation of part of an equity. If you're going on a bit further, you can see again, tokenized shares moving the market here. You can see that again, the number of Robinhood users and how they're shifting the market quite fundamentally. So these types of apps, these types of platforms are here today, are here to stay, I should say. And right now we have our core interest as an exchange, and indeed our DNA as a original software company developing some of these systems, was very fundamentally where the real world assets meet the blockchain technology and the markets. And there's all sides of the equation play in that particular statement, but that's where we think some of the highest growth potential exists. Our world, however, is based on something a little more fundamental. Our world is based on property. Although we like the technologies, we always felt that they needed to be underpinned by a real world asset for true value. When you have a Bitcoin, it's not fundamentally pinned on anything other than supply and demand and market movements. And so therefore it has functionality, it continues to grow, it's a useful structure. And indeed, some of the other technologies that have spawned from it, and I won't name them here necessarily, but we're watching a number of them because we can see that they have good potential value. So technology is here to stay, but the underpinning of the potential asset, getting an asset inside of a crypto, makes it much, much more interesting. As many of you will be aware, these are some of the numbers in London. So in London, for example, global property, 226 trillion, London value, transactional value of London residential property, about 54 billion pounds in 2017. So where does this all go? All right, we've got an issue where we've got digital representation of property in our model on public regulated exchanges. Now, here's a very interesting thing, and for all of you on the call, I hope you'll take this as a good takeaway. And it's this one. The trusted, regulated, insured value of property, title certificates in the financial system is far more valuable to the financial system itself than they are typically to the owner of the property itself. Now, that's a big statement. It means that if you find a way in a trusted, regulated manner to fractionalize, tokenize, or as someone told me the other day, to digitalize your property and have that as each element of those pieces, 100% trusted, 100% backed up by physical property, see it on Google Maps, have a due diligence firm, see all the research and information associated with that property so you can define its value, then all of a sudden you have a very, very trusted certificate, very trusted instrument, which people can then use to store their value, or indeed, in our future vision of this, to use it for other things. Now, a practical demonstration of this, because everybody always wants to know how it relates to them, is if you take your house. I don't know if we managed to capture anybody's houses here on this slide. If so, you might be very comfortable somewhere in California. But other than that, we ended up with a house in London, house in New York, house in LA. Take your pick. We then put it through a very rigorous process where we create what's called a Genesis record on the blockchain. The search and surveys using the Royal Institute of Chartered Surveyors Red Book. We add some extra data fields to it because we anticipate secondary markets appearing around some of the aspects or assets of the house. By the way, this also applies to green property certificates in conservation areas as well, which offers new revenue streams to green properties. So we have a green agenda and impact agenda running alongside of what we're doing on the exchange. Having got this, then you go through the rigorous process. It's registered, it's declared, it's validated. It goes to a standard that the TPX exchanges sets for all of the providers who provide the service to us. The conveyancing process is one that you've already seen, and indeed in all the markets that we're looking at, which generally are focused on where common law is prevalent initially. The standards that we're looking at here are standards that are already in play in those markets. And indeed, what we're looking to do on our exchanges with our partners is to produce enhanced standards for regulated exchanges to make sure aspects of nefarious or bad actors are removed from the process. The AML KYC standards that we are looking to deploy are a higher standard than regulated exchanges, we believe, in our designs here. So we end up, we think, with a better system. We also think we end up with much better information associated with the property. The land registry records are good, they're historical, but quite often in our current market, when people buy and sell properties, they're relying upon data that was achieved 20 years ago or 30 years ago. And in the insurance industry, they sometimes validate their insurance for a particular property by driving by the property just to make sure it hasn't burnt down. No chartered surveyor, nobody checking the property, no update to the records. And how can you build a system where your records are all out of date? So from us, Genesis Record, we do them to our design, a common design for all of our exchanges worldwide. And that allows the retailer or customer on our markets, be they retailer or institution, to have a common view by which they can look at the properties irregardless of geographic domain. There are different rules apply in different jurisdictions, different tax codes. We actually anticipate those, and we work with the authorities on a top-down approach to achieve what we're trying to achieve in terms of our regulated property exchanges. If you're looking forward, having got a property, fractionalized it, then we're taking those on to two different type of environment. We have the institutional trading environment. For the traders out there, you'll be aware of this level 2 data. You'll be able to see and recognize the screens that we use, designed specifically for that environment, as well as, and principally initially, the retail environment. And this is where it gets kind of fun, because the retail environment is not like anything that you've seen before. The retail environment is focused not on traders, because let's face it, traders in the world are a very small subset. Equity owners, relatively small subset. We're actually focused on anybody with a mobile phone and who has the ability or aspiration to own property. But what's different now is you can own a property at a much lower price. In theory, in design, everything that we're doing here is to enable people to start buying property in very small units of 50 pounds or thereabouts. And they can start to assemble their property or property portfolio and have all the pleasure of owning property without having to pay the current ante out, which can be anywhere from 50 to 100,000 to own your first house, and is unaffordable for many. Now we offer the real possibility that people can start buying houses and start buying property around the world via our exchanges, via our app, any country, anywhere, provided you can pass the AML KYC of the local regulator and you can open a client account, then you would be able to buy property in that city. That's our design. The good news for millennials, I hope we have some millennials and Generation Z and X on the phone here, on the call here, is that we offer the real possibility that people who wish to buy a house can go mortgage free, because now you're sharing your house on a common platform. Instead of the mortgage company and the pension funds that typically they might represent, you're now sharing your property with anonymous, theoretically, 10,000s of people worldwide. You never see them, but they're part of the exchange. And they are very keen to protect their wealth, particularly in a post-pandemic economy, to protect their wealth in a safe asset, in a regulated, trusted environment. And this is where we've actually, with our partners, have initiated something called the London model for the higher standard of transparency, trust, regulation, governance that all of our exchanges will exhibit wherever they deploy. So for you millennials, there's hope around the corner with the launch of our exchanges, that in this design, you would be able to buy a house at 51% of its asking price. And the remainers, the 49ers, as we call them, who own the rest of the property or portion thereof, would be able to share in the capital value of your house, but you're no longer paying a mortgage. All right, they're taking their view that they're protecting their wealth in the property itself and its performance over time. We also have rental share. We also are designed to be Sharia compliant within that rental share. So we have commercial property as well. The properties, when they go on the exchange, can either be a capital value property or a rental share property. So we've actually think we've covered many ends of the marketplace when we do this. Now this would be a bit of fun. We designed this. This is a Mark I, and we've moved several generations beyond what's showing in the screen. The logo that we're using is the Mine app, as you can see here on the right. But to give you a bit of a sample of this, here, while I'm talking about it, this is what we're doing with the exchanges. Yeah, it's pretty standard login procedures, legals, of course. You get to understand what's happening. You log into your account. You put your various details in, and here's the fun bit. You're now dating a property. This is Tinder for property. You're able to look at property in a very visual way, to look at it, experiment with it, see what kind of property it is, delve into the details as you see fit. Appearance does matter. You can choose which ones you want to use, to look at, trade with, ultimately be able to move those around, sell them. And a bit like the Robinhood app, should you need some money on a weekend, we believe by the time we've had this running for a few months, there'll be enough liquidity on the exchange that you could even sell some of your property on a weekend to raise some of your cash that you need to get through the weekend. In a post-pandemic environment, we do anticipate a lot of people will be struggling. We're trying to make sure that we can offer liquidity in the asset class by the virtue of our exchanges. On some of the numbers, if we're correct in our assumptions in the way that we're building our exchanges currently, we would anticipate numbers around 6.3 million client accounts per exchange. Our target is 20 exchanges over the next 18 months, 6.3 million accounts by year 3 plus on each of those exchanges. So there's some heady numbers in there. And we'd anticipate about 70% of the clients that will come onto exchange initially will trade. In normal fashion, they'll probably slow down over time to somewhere between, looking at some comparables, we'll probably anticipate about 15 to 30% of them will trade monthly after we've launched and after we start moving. Okay, if we look going on, our roadmap, here you go, here's get some of the interesting stuff. So 38 days to launch of the TPX exchange platform in London. We also have green property certificates due to launch on each exchange. We're still putting those pieces together, but we should have some ready, we believe, for the launch of each exchange. We see the properties as an asset-backed property coin, but it is titled, be clear, and people are able to trade that on the exchanges. We can see that theoretically, we end up in Libra territory, but using asset-backed instruments in that territory at some point in the future. So conditioning that very carefully as one of the things that we see that we may evolve to. We see property as a true unit of accounts in future. And when we designed a lot of these exchanges, we actually designed them exactly for the scenario that we're facing, where the government is looking to buy, announced today, for example, 100 million in bonds, corporate bonds, if but only they could buy 100 million in property certificates, which are owned by you and I, then the stimulus effect that they're all looking to achieve through modern monetary theory, MMT, would actually get to where it's most useful in the economy and drive consumption and drive spending, because that's what the economy needs most in the post-pandemic world. So we think our property exchanges in that world are going to become a critical tool of governments to enable their population to see them through some downtimes. Our objective is to get these deployed as fast as possible. They are a franchise model, and we're working with others to launch their exchanges at the same time as we're launching the London exchange. London is the headquarters of the company. We are based here. We've developed all this thinking and design here, working with many others. It's not just us. There's a lot of deep thinking that's gone into this. We are reaching out to governments around the world at the moment, and regulators, and central banks, and treasury. The list is almost endless, to brief them on what we're doing here. I'd like to give you a little bit of a launch. We'll make these pages available to you shortly. You'll see this on the back end. Hopefully you can see that screen kicking off. Maybe not. Okay, we'll make that. That's the campaign site. It's obviously not playing directly from within the presentation itself, so apologies for that. It doesn't appear so. Okay, that's Antony Abell. I'm the managing director, co-founder of the company.
Antony, thank you so much for that. We've got a bunch of questions. First question, what sort of market are you after with this? What's the market share? Who are you going after?
Okay, I mean, our initial market is for residential property, 100% old, freehold, ideally, for each market. We do have some of the challenger banks that are very interested to enter the marketplace with us, ostensibly buy out people's mortgages and allow them to list their houses. The challenger banks love this because it gives them a very good LTV in a liquid tradable asset class if our design is successful. So for us, we will be shaking the market up. We offer an alternative to mortgages in this guise. We do ask people, part of the assumption here, to just, I think part of that question is, people need to look at their houses a little differently. It's not just about the mortgage. Sometimes people feel a little uncomfortable to be open about it, that they might own their house with many other anonymous people. Arguably, that's not much different than you've got with a pension fund already. So, take it with a pinch of salt. But we think the value of taking your house from an illiquid asset to a liquid tradable asset that you can release in part equity without having to pay a mortgage is desperately attractive for the older generation who have bills to pay, medical bills to pay, children's weddings and education to pay for. So if they can see some liquidity out of their principal asset in a trusted, regulated environment that goes direct to market and it protects them in the future without having to pay for a mortgage or an equity release product, then that to me sounds like a better world and something that we should all look at and hopefully embrace. And that's what we're trying to do with all of our exchanges worldwide.
Is it worse in the US because of red lines?
Well, the US is a different market. And when we're looking at the US market, there's a lot more processes involved. For us, this is an intrinsic, we've done a lot of work on the East and West Coast of the States in preparation for the launch of our exchanges. So we feel that we're in a good position to launch in those. We've taken a lot of legal opinion. We've created the initial structures for the launches. So from our point of view, we can't see too many barriers to entry, but I must say the legal forms that you have to sign in the States are considerably more than you have to sign here. Unfortunately, the States has an aspect of building on their legal history based on antecedents, so that you seem to almost be signing all of the previous legal agreements as well as the current one. So it's a tougher market. It is a franchise model, so the co-owners that we're looking at in the States right now are willing to take on that battle and take it into the marketplace. We have been approached by different organizations to sell commercial properties. We got offered in New York a $300 million office building at one point to put onto our exchanges. The timing wasn't right, but we had hoped to visit more of those as we go.
How do the investors get allocated and have to pay municipal realty tax?
Each exchange is the same. 85% of the exchanges are consistent as far as our modeling currently shows. 15% is bespoke. So each jurisdiction has its own tax code. We do a real-time compilation of taxes as may be due on each and every exchange relative to profile of the account. So where taxes are due, I have to point this out, they will be paid. There's no escaping the tax man, as they say. And it is each of the exchanges the same. So as we launch each exchange, we sit down with the tax authorities, we sit down with local real estate market, and indeed it's local realtors that are looking to own most of these exchanges. That enables them to produce the systems that we're looking for with the tax being collected and paid. No, I can absolutely say that no property certificate can be awarded to the purchaser until such time as any taxes have been settled, and that's a standard rule on each exchange.
Technically speaking, you're not owning property, but a fraction of a property, and you share that fraction with other stakeholders that are unknown to you. Is that?
Yeah, that is ostensibly true. The difference here is it's not a REIT, it's not a fund, it's not a company that owns a property with all the execution risks that might be associated with such a company. What we've very carefully done is mapped the ownership that you have within the exchange and the property certificates, as we call them, on the exchange, directly with the title of the property. I'm not going to go into all of the detail here because it's taken us a number of years, and that's part of our uniqueness, having worked through that process to do this. So I don't want to declare it yet. We'll be declaring that when we launch the product. But fundamentally, you've got a direct correlation between the property certificate you hold on the exchange and the physical title piece under law, protected by law, of that property.
Who owns the house? Is it freehold?
Typically, freehold is where we're focused. Now, there's occupier rights on the house. There are different rules on the exchanges. So someone wishing, for example, we talk about the 51ers and the 49ers. It's the best way to look at it. There's always a 51% block. It can have different owners behind it, but on the exchange, the 51% owner has responsibilities to report to the exchange and has responsibilities for maintaining the insurance, which is not much different than you would have currently with a mortgage. But they have to report periodically to the exchange. So fundamentally, a 51%er would have to respond on a set interval with a report on the property. In 90% of the time, there'll be no change. People can still, within certain rules, put a new bathroom into their residential property, but if they put a cellar in or materially change it or add a new floor, and so on and so forth, and change the value of it, then it kicks off a relisting process. The 51% also has specific rights, and they have a call right on the 49ers. So if they sell their 51% block to, let's say, a developer, that they can actually force the 49ers to sell at market rate back to the developer. They develop a property, and from our world, hopefully relist it again on the exchange. We think in our numbers, this is interesting. We think in our numbers, this is forecast, so this is model, and I hasten to add that. We think in our numbers that we can see a 3 to 6% improvement on like-for-like houses listing on our exchange relative to not listing on the exchange. And the simple way of looking at this is that we'll see those numbers, we think, because the property is now a liquid tradable asset class. It's more valuable in itself because of that registration and the process it had to go through to get there, and the fact that the market's now valued it as well. So we think it is a tool by which many can increase the value of their homes over time at relatively low cost. The IPO process, as we call it, initial property offering, I stress here, is akin to listing, a new company on a stock exchange. A lot of process goes into it, a lot of research, due diligence, search survey. Those are all published in perpetuity for that property. And then we build upon the records that we create, as well as maintaining and monitoring that property and the owner of it for adhering to the rules of their insurance policy and indeed of the exchange. Key thing here for everybody is that when the property certificate is on the exchange, it's largely designed to stay on the exchange. It's insured while it's on the exchange. And if it trades on the exchange, it's free of any call or charge or leverage. It trades very clean on the exchange. And that's very important to us when we designed this, because we wanted to make sure we didn't repeat mistakes of 2008, where these collateralized instruments get buried in huge portfolios. And when bad things happen, no one knows who owns what.
On the same 49-51% line, assuming the 51% take out a mortgage and default, how much security does a mortgage cover? In other words, does the event of default by a 51%er, do the 49%ers get subordinated?
Yeah, I mean, fundamentally, the 49ers, that's the purpose of the insurance policies on the exchange. Title insurance, hazard insurance, default insurance. We even have step-in rights for extreme cases. We're there to protect the 49ers, to make sure that the defaults of the 51ers don't visit the 49ers. It may depress the value, but you shouldn't, if I may put it so bluntly, lose your shirt. The key thing about having an exchange such as this is that you have the mechanisms within it to maintain a free and fair market value. We'll see as we go along, undoubtedly, particularly for the rental properties. You'll be able to define the good landlords and the bad landlords, who actually manages their properties well, who manages them badly. And those numbers will become apparent, and the market will follow those who do a good job.
Does the cost of where you say you can invest from £250 per slice of property, does that include the insurance? Do you handle all of that?
The insurance is actually the responsibility of the 51er. So it's not built into the 49ers price per se, at least not directly. So there might be some indirect effect, but the 49er is not expected to pay for the insurance now.
If somebody is hurt on the property and it's judicially decided that liability rests with the property owner, what happens to the 49%ers when the 51% cannot fully cover the liability and the aggrieved party is looking for the deed?
It's a very good question. In the structure of everything we're doing on the exchange, we have done, I think, absolutely everything conceivable to make sure that the 51% carries all responsibilities for the property, anything that happens on it. The 49ers, it's very carefully designed. So, for example, we don't want a class action to be taken against the 49ers, somewhere like the US. So when we're looking at the construct of this and the legal code that we're applying to it, we're being exceptionally careful to make sure that the 49ers are not held directly responsible for what the 51%er did or did not do.
Who do you target on the institutional side? Is it property funds or pension asset owners?
Well, this is kind of fun, I guess, a little bit. I'll go into this ground. We have a deal room structure. We think, quite honestly, the most lucrative end of our exchanges as they launch are the new properties that go through a pre-IPO process inside of our deal room structure. Everybody's allowed in the deal room structure. And the prices that we have, because we need to have the market confirm the prices before the properties go on to the exchanges. We have AI engines operating on this. We have other historical aspects of it on the valuation curve as such, looking at this. And the vendor ultimately has the final say on what price it goes on to the market at on that first sale. One of the key things we're very keen to do, though, is only a portion of each IPO goes to the deal room structure for price setting, price confirmation. The majority of each property that we list on the exchange is designed for the retail market to benefit from. If we get our model just right, and this is again caveated with forecast and model, we would like to think, unlike a Robinhood where you have a figure on the front of your website saying 76% of people, retail investors, lose money on this product. If TPX gets this right, our Mine app will have the opposite of that. We'd like to see 76, 80% of people on our exchanges making money. And we think that's a realistic goal because we've identified already enormous amount of wealth in the world that is very, very keen to find safe haven, safe harbor, particularly in the post-pandemic economic turmoil that, don't get me on that subject, that we think many of us, or all of us probably, will sadly face. There'll be a big push to preserve wealth for those that have it. There'll be a push for those who have it and need to exercise wealth to find a mechanism by which they can, in small parts, achieve some value for that wealth, in this case, property. We're trying to enable that process for everybody, both ends of the spectrum. We're looking at the democratization of the ownership of property here. We want to make the ownership of property for the many, not for the few. We're trying to move the ante up for people to buy into property. So in this model, property becomes a common asset and not an uncommon asset. And if we have success in any of this over the next few years, we'd love to be judged that we've made this more inclusive. From our side, you saw the video I had earlier where people are disenfranchised from the ownership of their infrastructure. We feel very strongly if your aunt or uncle, your brother, your friend, your cousin owns that house over there, you're more likely to say something when someone sprays it with paint or tries to burn it down. We need to own a greater common ownership of our property around us. We think that's going to happen. We think it's going to happen because of the intrinsic problems of the financial system itself. This is not new. We've looked at over 200 years of economic history. A lot of what's happening, we believe, will see variations of rebasings of economies. We don't know all the answers for these. We don't know what they're going to look like. It's many times beyond our pay grade. But fundamentally, the world is changing. We think asset-based economy is the core of it. We think property is big enough, as you saw from some of my previous slides, to be able to handle a rebasing of a lot of our economies. And we think it's an intrinsic, valuable asset with the demographics associated with it, increasing demand, limited supply. It's as I said, investment in houses quite often save as houses. So we think we've created a product now here for our current times. We designed it for a down economy. We anticipated a down economy. We didn't quite expect one as bad as this one or the one that's coming, but the same rules apply. We're here to serve a greater marketplace.
Cool. Thank you. How are you valuing the underlying asset and revaluing that?
Oh, I suspect maybe you're a chartered surveyor. Valuation is basically, we're using the Rick's Red Book on this, in terms of the fundamentals of that. We have market aspects of it. We have an AI engine under construction now for the exchange, which will give a price guide. It's really just a range. People, of course, the market can do whatever it chooses. We're very, very aware that we don't want prices to inflate themselves. This is not a crypto exchange. This is an asset exchange based on the fundamental of property. Property has known values and known market metrics. From our point of view, we want to publish those and make them available so people can see within a range what's a reasonable price or an unreasonable price. As always with property, market knowledge, local knowledge plays more heavily. It's very different from an equity exchange. We have to look at that in some of the security protocols that we build into the system to make sure people aren't gaming the system or front running or creating artificial prices for others to buy on the exchange. We spend a lot of time on that. Security, like any exchange, is the #1 issue. And so for us, we think we've got quite a balanced approach to this. Valuation, we will see. Expect probably our own numbers are a 3-6% increase on the value of a property entering the exchange versus one next door that hasn't entered the exchange on a like-for-like basis.
Cool, thank you. Who lives in these houses?
Whoever wants to live in the house. The occupier rights, inevitably, a lot of this is existing housing stock and freehold that people are looking to achieve equity release off of. We anticipate more and more of that, sadly, because of the economy, where people are looking to after the furlough wears off and government money ceases to flow as freely as it does, people will struggle, and we're acutely aware of that. So people will look to try to find a fair system to see value on their property. But that's a fair exchange because a lot of people around the world have money, are looking for a safe place to put it. The UK is a very safe place to put it. Rule of law, governance, transparency, regulation. So from that point of view, we are keen also to stop the problem that we've seen in the past, particularly in London, where you have absentee owners of properties. They buy properties as typically a capital asset, then they don't live in it. And we've seen a lot of that on the West Coast of North America as well. we offer a better version of this. It's not good to have absentee landlords. We have duties and responsibilities for the 51% owner on the exchanges. They have a reporting requirement, and we have rules by which we can step in a worst case scenario to make sure that the property maintains its relative value. In terms of who lives it, anybody who can achieve the 51% and buy that stake has the occupier rights, and the same occupier rights as currently exist under law also exist for that occupier.
Thank you. How would you do a property buyout, for example, if you own 51% and you want to buy the remaining 49%?
Typically, the mechanism is you signal to the exchange that that's your intent, and you buy out the rest on a forced redemption event at midnight, typically when the exchange isn't trading. And that's designed inevitably for people to develop those properties. You can, because we notice the pension funds inevitably like a longer return over a longer period of time. Owners of properties, the 51%, can effectively lock those up to allow the pension funds, particularly rentals, to allow those longer term annuity streams. So you can, the vendor of the property, the owner of the property who has that 51%, has the right to choose to put it into a different type of instrument and not exercise their redemption rights for a period of time and create a longer term yielding product for the pension funds and others.
Cool, thank you. Are you pricing in credit risk of the borrower or homeowner? And what happens when they default on a borrowing secured against 49% loan to value? Where does that leave the value of the digitized 51%?
Okay, I'll try to answer that best I can. There's always a remedial period. This does already exist in law. If a homeowner fails for whatever reason to meet their obligations on the 51%, then they have a remedial period by which they can set. The insurance covers that in initial stages. Insurance is not designed to cover that forever. At a certain point, a forced redemption event can happen after all the remedial processes have been worked through, and in theory, then the house can come back onto the market and be sold at market rate. Now, the new owners may wish to take the 51% and exercise their redemption rights, having got that. And so that's how we see the 49% is looked after. It might mean, I guess, at one level, while there's an issue that those particular 49ers are not too liquid. The shares are currently in a process, but they should come out of it with value.
How would an investor be confident of a secondary market, and is there a market maker?
This is a very live discussion at the moment. We have other brokers, and the exchange is designed to host other exchanges within its ecosystem. A lot of these are currently under discussion right now. Those are ongoing processes. I'm going to be a little sensitive about saying too much about those yet. The issue we face, particularly as an exchange, is to make sure the rules that we have for our asset class, property, is maintained throughout the process, and that the property certificates that we create are live property certificates. We know who owns it at any one time in the process. That's periodically recorded on the blockchain to make sure that the registry continues to exist there and can be verified independently at any stage. So from our point of view, we're very keen to run a system whereby the other exchanges are taking broker seats with us. And indeed, rather than having certificates trading on secondary shares, we take on secondary markets or secondary exchanges where we feel the sanctity and protections that we offer on exchange can't be maintained. We actually have various mechanisms by which we can keep those certificates with their insurance, with the commitment to make sure they have no liens or charges on them, trading freely and openly on our exchanges. We can't guarantee that if they go on secondary exchanges outside of our ecosystem.
Is the need for multiple exchanges down to the different regulatory environments? And could you also unpack what you meant by the reference to a franchise model?
The design for us as an exchange operator, having designed the systems and created all the tools, so to speak, within it, our principal focus is to provide liquidity to our co-owners on the exchanges. We see ourselves as co-owners and partners. And indeed, we work very closely with them, and we have a feedback loop and enables us to feed information bilaterally across the exchanges to make sure that we can police and monitor them correctly and provide the security, of course, which is essential for any exchange. It is a franchise arrangement. From us, on a London perspective, we do not seek to own our exchanges in perpetuity. Our model is very much a franchise. At the start of trading of each of our overseas exchanges, we look to be below 50% and not to be identified as the operator. We want the local realtors, real estate agents, tier one banks, partners, ex-regulators, as some of them are, to actually be the owners of their exchanges, to be identified in the local community as the owners of the exchanges, and those exchanges to be seen as their exchange, not ours. We're there to provide the systems and the processes. We're not there to take the limelight, so to speak. We want them to own their exchange, and we're going to do everything we possibly can to support them in that.
Okay, thank you. Used as a securitized collateral.
I'll tell you a bit of this. There are parts that I can't disclose yet. In some of the discussions we've had with tier one banks, they're very, very interested in those certificates being available on their balance sheets. In some of the banking infrastructures and central banks infrastructures, there's a live interest, shall we say, at this stage, that those property certificates can exist on those balance sheets. The key thing about us in the way that we're doing is there's no ghosting or hedging or puts around these property certificates in the way they exist. So they exist in or of themselves in time and space, and they're identified cleanly on the system at all time, and who exactly owns them. In our modeling, we believe, if we're correct in this, the property certificates that we generate will be of a very high credit rating and caliber at the AAA sort of level. We anticipate that the banks that we're talking to are very keen to have them on the balance sheet, and we anticipate that they'll pay a higher interest rate for those property certificates on their balance sheets than they will for equivalent amount of cash deposited with them. So from our point of view, if we're correct in this assumption and the modeling, we will see more people putting their money into property certificates to save them and earn an interest rate than they will be depositing cash at the banks in the future.
If you're only after sophisticated players, will that not exclude most people?
No, key for us is to create an open environment. There are, to be fair, on the more senior accounts, we have 7 graduations of trading accounts on the system. The most senior level is we affectionately call them global moguls. The global mogul account, the top tier account, is obviously under a certain amount of scrutiny, and they have to pass a certain more rigorous AML KYC process, and we have to clearly identify who they are, source of funds. And although that exists at all stages throughout the exchanges, there are definitely graduations in that process. And the more senior accounts have more rules that apply to them.
If one can buy or sell shares in the property whenever one wants, and can one speculate price spikes?
Well, speculation always has its dangers. The first thing I would add. What goes up can come down. But fundamentally, yes, is your answer. The entire Mine app that we've developed is designed to make the property certificates maybe at a price discount, but to make those assets, if we're correct in everything, instantly liquid. So if you literally, we've seen some of this in some of the other apps in the equity world, some of the ones I mentioned on the previous slides, that they actually have the option to sell now. We have that same function on our system. We anticipate in a post-pandemic world, people will need to have access to cash. The cash that we're enjoying now from our governments can't last forever. The world needs to shake itself out a little bit. Assets such as property will become more valuable, we think, as time goes on. The monetary and fiscal policy that many of us that are operating under will put more stresses and strains on the system. We are anticipating high inflation rates. So increasingly, the fundamental assets of the world, back to basics almost, will become more valuable. And we try to make sure that at the lowest possible level, to the broadest possible audience, that people can buy and sell property on all of our global exchanges, and indeed, hopefully protect themselves. Though that includes not just people who are buying and selling on the trading side, but indeed the people who choose to list their properties with us, put them on the exchange, and create liquidity in their principal asset that way.
How inspectable and public is the chain, and therefore how are you handling the standardization of data format across an asset class that differs so much from asset to asset?
Yes, it's always constant. We publish the structure, what we use in one exchange is the same data structure that we use in all our exchanges. We're very keen that in the user experience, people can find where the information that they're looking for might apply. There are different rules. We try to signal that we can't give advice as an exchange operator on our exchanges. We're not in that role. We're not regulated for that. But fundamentally, we do try to produce as much information. The records, the search, the survey that is associated with each property is available via the ticker symbol in our systems, on our trading systems, and users can drill down into effectively the due diligence room for that property. There's also off-block marketing sites which provide the media-rich type environment for people to have a closer look at the look and feel. And we even have A-listers who are very keen to put their properties on our exchanges because that inevitably enables a greater value for their own property portfolios, as well as making sure that their names may continue to be live in the firmament. So we have a rich profile of users on the system, we think. The key thing is to make it slightly more egalitarian and open to all and accessible to all, because I think in our common interest, that's where we need to go with this.
How does your product fit with the current regulation? Have you worked with any regulators to introduce specifically?
Everything is done. We applied for the second. I have to be careful how I choose my words here because I can't use the regulator's name in vain. I hasten that for any regulators that might be on this call. We started with the second cohort of the FCA Innovation Program. We applied for it. They quite rightly looked at us and said, it'll take a little while longer than you think to get something like this up and running. They were absolutely right. We've been working with 2 members of the FCA Innovation team since then. We continue to do so. We applied, I think, early 17 it was. And we've been carefully and patiently trying to get all this right. We've reached out to government agencies. I don't want to name them here, but all the principal ones you'd expect us to reach out to work with them, to engage with them. We see ourselves as a top-down configuration for this marketplace. We are not a bottom-up. We're embracing the regulation, and indeed, it's one of our core selling points. That trust, that transparency, that rule of law, that regulation that we're building into the system is absolutely critical for people to trust their primary assets to us, and we take that very seriously. And indeed, for those who are coming on the trading account, we want to give them a fair shake of the stick. We want to feel, as per the core name of the company and our core DNA, the core name of the company and the holding company is Universal TrustMe Engine Limited. TrustMe is a very difficult thing to ask people to do at the start of a relationship. Trust, believe me, we spent a long time looking at this, comes from multiple transactions between known and identified parties over time. And we still have to earn our trust, to be fair. But that is where we're going. That's our DNA. We want to get this right.
Thank you. And the second part of that question is, have you worked with any regulators to introduce specific new guidance for this fractionalized ownership investment model?
We had some initial discussions around these pieces. Again, I don't want to go too far on that one. If we get this right, we are very keen with others in the industry to standardize a lot of the pieces here. This is a product, the right place, the right time, we believe. It solves a lot of problems, not only for the retail end of the market, but the city itself, the financial district, and particularly government. Doing 100 million in bonds, corporate bonds, does not a stimulus make. It doesn't necessarily get to where it needs to get to. If but only we can make property a common asset, which everybody owns a piece of, or has a reasonable aspiration of owning a piece of, then that stimulus program could be better directed to go where it has the greatest effect, which is you and I buying more stuff in the stores, quite honestly, or just buying enough to survive on and live on, pay our fees, pay our taxes, pay our kids' education, whatever the case may be, new car. That's where it needs to be. That's where it has the greatest effect. So we're actually reaching out to governments at multiple levels, quietly, informally, to highlight what it is that we're doing and the effect we believe it will have on their national economic interests.
What are your projected revenue streams? How are you currently financed and owned? And you mentioned local franchises in the US, and who's doing
John?
it? I'll share your contact details in the email afterwards. That's fair. How do securities laws apply to what is essentially a real property asset? And that there are different legal contract realities for real property and other assets, which rules govern.
You're right to ask the question. We've been working, we think, diligently through this process. To be clear, when we first looked at this, and on a literal sense, you could make a very good argument that what we're doing in its first phase doesn't actually fall under the remit of the FCA. We knew that. We actually approached them and said, we'd like to be regulated. I think we were the first organization that ever went into the FCA asking to be regulated that ostensibly didn't need to be regulated. We're doing that because we know that although the first one is a direct-to-market aspect where principals are selling to each other in the first deployment of the exchanges and each of their locations worldwide, we knew very quickly that the REIT market, the fund managers, would like to assemble different performing products for different markets, and we're encouraging that. We want them to do that. It is designed very much for the institutional market to build their own products and build their own offerings into the marketplace. And as we go, we knew that was going to happen. We approached our regulators on that basis and said, it may be that for a few months we're in unregulated space, but sure as damn it, as soon as we switch a few switches over here, that we're absolutely in regulated space with some of the actors inevitably producing these types of products, giving advice, et cetera, et cetera, et cetera. So the short answer is we started as we meant to be carry on. We want government to work with us. We're encouraging them to do so. We're doing a lot of novel things. We're doing arguably a lot of novel things that need to be done and need to be done fairly quickly. We anticipate a very positive effect on property. We anticipate a net inflow of capital in the United Kingdom if we're successful in scale. That should add a point or two to the GDP of the country. And so that's where we're trying to drive a lot of this. It'll take time. We're a property exchange. That's our focus right now. We want to get it right. We want to work with our partners, government and outside of government, to get this right. And we're treading carefully as we go. We take what we're doing very seriously, and we're taking the asset that we're working with very seriously indeed, because it is the principal savings of individuals.
Do you hedge for currency risk based on real estate in other jurisdictions?
We buy and sell property on our exchanges. Yes, there are FX elements within the payment rail platforms that we work. We pass those benefits on to the end user. Yes, inevitably, as you go through something like this, don't forget, we're not holding client funds per se. They're in the client's own accounts on our exchanges. There are FX pieces within this, yes, inevitably. And we work with those with our partners. But we do try to make sure that as much of the benefit of that is passed on to our clients. Our payment rails are designed to work directly with existing tier one banks. So a bank transfer from your high street bank as such goes directly into our platform and works in ways and fashions that people are quite used to. We're talking to other third-party payment providers, we haven't announced them yet, to provide greater facility on it, including various payment rails that allow us to access WeChat and Alipay. So we've got a way to go yet. We'll be making announcements as we go over the next weeks and months to come.
How do you earn your fees?
Inevitably, our fees are based. We're doing actually kind of interesting. We are doing a pricing review right now, so there's some statements we hope to make later, but I have to be a little careful not to say too much yet. Our view as an exchange operator is every time a property certificate moves is, yes, we would encourage, we're getting some sort of fee. As a property lists on the exchange, yes, we're making a fee on the listing process. There's a lot of work, believe you me, that goes into getting that right and maintaining all the systems behind it. So the short answer is every time a property certificate moves, we get some funding from our partners that are working with us, and some that are looking to join us on the exchange. So there's a multiple sources of income that come into the model.
For property in the UK, how does stamp duty land tax tie in with the trading of the property certificates?
I'll give you the answer as we are configured right now. If you buy and sell property on the exchange and stamp duty is due on our exchange in the way that we've constructed the exchange, and there's some issues about how that works, and we're using legal structures that have been in place for over 50 years on pieces of this. There are certain thresholds where stamp duty currently may not apply, and it depends a little bit on the profile of the account. We anticipate that most people trades will occur in below that threshold. Some will exceed that threshold, depending on the profile of their account. So it depends answer. And if any stamp duty is due, it's collected on the exchange, and the certificate is not awarded to the new owner until such time as settlement has taken place with HMRC.
Do the certificates change the tier weighting banks have to apply for holding? In other words, can certificates be considered tier one capital?
Currently, that is under discussion, is the right qualified answer.
Okay.
If you look at the profile of what we've done, that is where we end up, yes.
No, thank you.
Not yet.
Will this be operated at an international level, or can overseas people buy the holding?
The retail app mine that I briefly showed you, the Mark I prototype, being careful not to show you the most recent version, that's a global app. That is designed as a global app. Anybody, anywhere in the world, where there's no restriction for them trading on the exchange, and they can pass the local regulators AML KYC, and obviously have the banking facilities that they can fill their client account, then they can trade on any of our exchanges. Our function really as an operator is to drive liquidity to all our exchanges and all our markets. So we have a global app. It's designed to go out in multiple languages, jurisdictions, and it's targeted at anyone ostensibly with a mobile phone and any spare capital that they wish to put into a solid asset such as property that they now can invest in any of our exchanges.
Perfect. What is the VC appetite like for companies that tokenize real estate?
Good question. It's a very good question. I've built a lot of tech companies. We don't actually have and haven't dealt with any VCs on this at all. We've coming out of the works on this one. Most of them probably haven't anticipated that we're coming. It's designed that way. As we launch our global exchanges, our version of this one is we end up with one common system but multiple owners. And that's to the better of everybody, because then we can drive liquidity for all of the exchanges better than any one exchange would be able to drive liquidity just for itself. So our catchment area is, from our point of view, global. We should be able to drive some good and big numbers into the exchange and through the exchange in due course by the many as such model. Over time, the institutions will get on board. We believe very firmly. It takes a little while for them to get over the indigestion caused by their compliance departments, but that's a normal process. And in due course, we expect a lot of institutions to pile in, work particularly in the deal room structures, provide some of the market making capability that we're looking for. So we're having some of those conversations now, but generally we're focused on funds, high net worth offices, family offices, sovereign wealth funds. We barely touch the VC community today.
Everyone, thank you very much for joining and for the questions. Antony, thank you very much for sharing your knowledge and time and answering all of those questions for us.
Well, thank you, Erica, and everybody stay safe out there.
Have a good night. Thanks. Bye.
Okay. Bye for now.